From the College by the Lake, Coeur d'Alene, Idaho. Local, regional, national, and international guests discussing the issues and topics affecting the way you live are on Forum, the North Idaho College Public Forum, with your host and moderator, political scientist Tony Stewart.
It is always the goal of this program to bring subjects to you that you're interested in, and also it's very helpful to you. Certainly today's program falls in that second category as well as the first. We want to be helpful to you, and we know this is tax time across the United States and here in the Northwest. And we're very fortunate to have three guests today, all of them highly qualified to discuss taxes and what you should do in preparing your data for your certified public accountant, or if you're doing your taxes yourself. And therefore I am at this time pleased to welcome to the program. First of all is Rob Chatters. Next to him is Tori Gray, and next to her is Randy Bates. All three of these guests are CPAs, and they are headquartered here in Idaho. And I want to say on behalf of our staff and our panel that you're busy. What a busy time to have you to come to the program, but you've taken time out this afternoon to do so, and we thank you very much. And we're going to address a number of issues that deal with preparing your taxes. And as always, I welcome to the program our regular panelists. First of all is Janelle Burke, who is an attorney in the state of Idaho. And next to her is Steve Schenck, the Dean of College Relations and Development at Idaho College. And as always, I shall ask Janelle to commence today's questioning.
It's that time of year again, and assuming that a person now has their appointment with the person who's going to prepare their taxes, and now you're getting the things ready that you need to take with you. Rob, let's start with you. What should a person be looking for and be preparing for in order to take their information to the person who's going to prepare their taxes? And all three of you can answer at any point in time, but we'll start with Rob and then go maybe right down the line and talk about things that are good to take with you to your initial appointment.
Well, certainly there are several things. This time of year you'll be receiving a number of documents in the mail that on the cover will say important tax document, and you really want to open those and take a look at them. Normally you're going to get your W-2s if you work for a firm that issues them. You'll get 1099 interest from banks or other entities that are paying you interest. You might get dividend statements from stock investments, or if you're through a brokerage house, they'll send you a year-end recap that'll have your dividends and break out how to report those dividends. They'll have your stock sales that they have reported to the Internal Revenue Service, and that kind of information you'll be getting in the mail. You'll also get, if you have a home mortgage or a home mortgage in a second, you'll get a 1098 that reports what you've paid in home mortgage interest. So certainly those things are going to be coming. You may also be getting year-end statements from your church. If you're tithing through their envelopes, they'll keep track of it and give you a year-end report. If you work with an accountant or a tax preparer that sends out an organizer, you may be getting that in the mail, and that's, to the tax preparer, a very useful item for you to have gone through and filled out. Normally, like the ones that we have through our computer system, will show things that showed last year, as a reminder both to the taxpayer and also to the accountant that, hey, the taxpayer didn't put this down. Is this something we need to ask them about? If you've sold any property during the year, real estate, or bought any, you'll need to gather up those closing documents. Charitable contributions, the receipts for those. And the preparer may not necessarily want to see all those receipts, but you're going to need them as backup should you have the good fortune of being audited by either the federal government, or if you're in a state that has state income tax, by the state government. You'll need those. Your preparer doesn't necessarily want to see the whole stack of receipts or shoebox or whatever, but you'll need those as backup, and they help you gather information. Your check register is a good source to go back and reference from, but they won't necessarily accept the checks as documentation. Certainly, for the federal government on contributions, if it's over $250, you need to have a receipt. You don't need to turn it in, but you need to have it as backup. Those are the things that come promptly to my mind.
Tori, do you have something to add that is helpful to bring along?
My advice would be to be as organized as possible, to take that time at home to organize and summarize wherever possible, like items, contributions, medical expenses. You're paying us for our time when you come in to see us, and it really is helpful if the taxpayer does not bring in the box of receipts and ask us to summarize. We're glad to do that, but it can get expensive for the taxpayer, and we want to keep that reasonable, of course. Another thing I think Rob did not mention would be Schedule K-1s, which you get if you are involved in a partnership, an S corporation, a limited liability company. Those trusts, those can often be the last item you're getting, and that's what everybody's waiting for. So to be sure to be looking out for those. Also, the basis of assets sold. I think Rob touched on that, but that can really be a time-consuming process. If it's something you've owned for many, many years, we need to know what it costs you. What do you have into it? And so I'd be looking into that before you come see us.
Does it help to have a sheet of paper on which you have, for example, one sheet of paper where you've listed all the income, another sheet of paper where you've listed all your deductions, so that when you come in, you have that, then you also have your W-2 forms and your 1099s and so forth attached to that sheet of paper? Is that helpful?
That would be very helpful. The organizer that Rob was mentioning follows that same pattern. It's just a different form. We have many clients who prefer to use their own summaries that they're comfortable with. They've been doing it that same way for 30 years. That's fine. The key is to just be organized and to have it in some logical manner where we can sit down and ask you intelligent questions about it, and do that follow-up right there while you're in the office.
Now, Randy, what about IRAs? Making some contributions that way to lessen your tax liability.
Yeah, that's one where it depends on all the rest of your income and whether or not you have other income of which you have a pension plan, as to whether or not it's going to be deductible or not. There's various limits on that as to how much you can make and still deduct it. Everyone can still deduct or can still make an IRA contribution. Whether or not it helps them on this year's taxes or not is a whole different deal. I get quite a few clients that want to do an IRA, but they don't know if it's going to help or how much they're going to owe. And so what we can do is we can basically do the whole return for them, and then call them up and say, if you do make a $2,000 IRA deduction, you'd still owe some amount of money, or if you don't, you'll owe this amount, or how much of it would be deductible. They have until April 15th to make the deduction for the prior year, so it's not something they need to have done necessarily before they come in if it's questionable. Quite a few people, even though they know it will not be deductible, will still make the IRA contribution, knowing that they can put some money away for retirement. It'll earn interest tax-free, basically, and they'll worry about paying tax on it when they retire and take it back out. And if it's not deductible, they won't really pay tax on it when they take it out then, but it's the interest will be at that time. But it's just a way of saving that it forces them to.
Steve Sheen.
You know, I've been thinking that maybe we err in believing that people know more about taxes than they really do. So I want to ask just a series of very basic questions and maybe set the foundation for the rest of what we're going to talk about. And I'll just go down the line and start with Rob. Rob, who has to file?
Basically, anybody that has taxable income or income over a certain level, and that level varies depending on if you're married, filing joint return, married, filing separate return, single, if you're a child claimed as a dependent on another person's return. So it really varies there. For example, you know, my children, you know, my son who's 13 has to file a return when his interest or dividend income hits $500. And then when it hits $1,000, it gets, or $1,200 I think it is this year, it gets taxed at my rate. My 17-year-old gets that same $500 for free, and then anything above that is at his rate. You get someone who's not claimed as a dependent by anybody, they get their standard deduction, their personal exemption, and that's, as a single person, that's going to make around $6,500 roughly that they can earn either through interest or dividends or earnings and not have to even file a tax return. Senior citizens married filing jointly, they're in the range of about $13,000 before they have to file, and that does not include Social Security. So it really depends on a lot of different factors, but you know, you look at that, and there's certainly people out there that don't need to file, and And some of them file every year anyway, especially senior citizens, because they're so used to filing. They're afraid of the IRS, Internal Revenue Service, sorry. And even though you tell them you really don't have to file, oh yeah, I want to file.
See, I think I'm asking simple questions, and the answers are not all that simple. Tori, my question for you is, what constitutes income, and what kinds of income are exempt from income tax?
Well, that is a complicated question, but basically,
Seems simple when I wrote it down.
Yeah, income from work is certainly taxable. Income from business activities, other items of income like Social Security may or may not be taxable depending on your other factors. But if you're only getting Social Security, you're probably okay. Other forms of retirement income are taxable. Pensions, IRA distributions, that type of thing. I'm afraid I can't answer that one easily. It is a complex issue. There's some tax-free earnings you could have, municipal bonds, that type of thing that may not show up on your tax return but still need to be considered in your overall tax picture.
And Randy, I thought I'd ask you a little bit about short form versus long form, and the question of what's left that's deductible. I know there are fewer and fewer things these days.
Yeah, that's a fact. The main thing is that most people end up going to long form on is when they own a house and they're making payments on it. That seems to be the thing that gets them up there, which is basically the itemized deductions consist of major medical bills primarily that they have to get up to a certain range before they even count. House interest is, property taxes are included in there, state of Idaho income taxes or any state income taxes, church contributions, and some miscellaneous business type expenses. If all of those total up to, and once again, exceeding a number that depends on whether you're single or married or not, which is somewhere between 35 or 6,000 or 7,000, it changes every year. You get to take the larger of the standard number or what they actually total up to. Most people, once they get to where their house is pretty much paid for, if they don't have big church contributions or big state of Idaho income taxes, they end up being able to do short form, provided they don't have a rental house or another partnership that they're involved in or a myriad of other things that require more pieces of paper. Even just a little business on the side will require the long form. The short form is basically when a person retires, is primarily it, or the student or just out of college type person that doesn't have a house yet. And most of those don't need the services of a CPA, although we get a few of them. They're not that tough of a formula to work through, but most of the clients that we end up always have a business or a rental or something that makes it a little more complicated.
And my last simple question, if I may, I'll go back to you, Rob. Randy mentioned filing singly or a married couple filing jointly. Is it always the smartest thing for a married couple to file a joint return?
Not always. They do have a schedule called married filing separately. Mm-hmm. And the most common place that seems in a lot of the literature you see where it works out not to do it that way is and it works better in a separate property state than in a community property state like Idaho or Washington, is if one of the individuals has low income and high medical expenses. To where on a joint return, due to the floor that they have to exceed, it would fall out. Or like in this year where you could be taking some casualty losses due to flooding or the ice storm. Maybe this would be a year where that might also work, but it really depends on, community property state is tough because in Idaho and in Washington, everything belongs, other than specific separate property, everything belongs to the couple, but that's where it works out.
Thank you.
Tori, I'm going to start my question with you. Before we started the program, we talked about the fact that from year to year, the Congress changes some provisions within the tax law. And I will preface this by saying that you informed me that 1997 will have major changes, and we're going to have a program for our viewers at a later time,
right.
And we'll come back and deal with that. But since they are filing the taxes for 1996, can you give us any idea of changes that people should be watching for that was different from 1995?
One big change is the state source tax on retirement funds. Prior to 1996, for example, if you worked all your life in California, retired up here, California still taxed that retirement. So you had to file a California tax return, do it that way. They can no longer do that. So now your income will only be reported to the state of your residency. So it may not make a big difference in the bottom line tax because of other provisions that prevent double taxation of the same income, but it will simplify your filing a lot to only have to deal with one state. There's some other carryover things that changed. Prior to 95, you needed, or in 95, they changed the rule where you needed receipts for business expenses from $25 to $75. So now you only need to have to keep that receipt for over $75. That changed in November of 95, so that really hits people for the first time in 96. Some other changes that carried over from prior years that are still hitting people is the nanny tax, started in 94, but we're still seeing a lot of people that aren't aware of those provisions. If you have the household help, you need to be reporting that on your tax return and paying the taxes. There was some changes that affect self-employed persons. Your ability to expense equipment has increased. I'm sorry, that will start to increase in 1997, but they should be aware of that because they'll be buying equipment all year long. The health insurance deduction they can take will increase.
If I can back up a moment, some people at the national level have had problems with this when they were up for confirmation in hearings.
Yes.
Not only do you report on your tax form the income and so forth that person gets, but are you obligated also to pay some other types of tax on like a quarterly basis or annual basis for those employees?
They've really simplified it from the rules where you had to be filing quarterly, and now you can do it annually on your tax return. But there is payroll tax issues that you need to be addressing over and above the wage you have paid them. Depending on what that wage is, the rules are different.
Both Randy and Rob, would you like to add anything to changes that have come down?
It really gets into a mess because actually you're supposed to be figuring out some state unemployment taxes on these people and filing that return, the federal unemployment. There's a myriad of other taxes when you hire an employee other than just a little bit of Social Security tax to withhold, and so it gets into a can of worms.
Well, I think it gets into a can of worms also because the people don't want to report it. You know, the people that are working for you, they really, a lot of them, I think, want to do it under the table. And, you know, I got a call from an elderly client who has home health care, and people she pays, and she says, well, they don't want me to do it. I says, well, you want to do it because you don't want to get in trouble with the government. And so they use that. Another change that may be one that will be a little bit unpopular up here is that, you know, it used to be, you know, they had, if your child was a year old, you had to have the Social Security number, and a lot of people still didn't do it, and the government just kind of poo-pooed it away. Well, now if that child is born before December 1st of 96, if you don't have a Social Security number on that child on your return, they will disallow it as a mathematical error, and trying to get that corrected back is going to be a real battle. Because I know I've had clients that really don't want to give them their children's Social Security number, or divorce situation where they never got it and the wife got it, but they get to claim the child and they don't know what it is, and trying to get it from the ex can be a problem. So that's something that people really need to be aware of for 96, is that they're cracking down on that. So basically they're saying you can get a Social Security card fast enough that if the child was born after December or after November 30th, you better have that number on there.
Janelle Burke.
Randy, let's start with you this time. What about the situation in which people have income from more than one state? There are a lot of people here in North Idaho particularly who maybe actually reside in Washington, but they have summer homes here in Idaho or whatever. How do those rules affect from state to state?
When you do the federal return, it's all the same. They don't really care. All taxable income gets on the federal return, and all allowable deductions get on the federal return. Then it's a matter of states on who gets to claim that income and those deductions, and usually the way it works, what we see here is people in Washington who come over here and work, they don't have a Washington income tax return, and they might have half a year of income, or the spouse may work in Washington and the other one has some over here. Well, they have to file an Idaho part year or non-resident return. It's the same piece of paper. But basically, Idaho wants claim to the income that is earned in the state of Idaho, whether you live here or not, and they will allow the deductions for it. So you run through a calculation that basically shows they made $50,000 total income and 20 of it was from Idaho, so you run through and Idaho gets their cut. The other scenario we see here quite often is a person who lives in Idaho and they might earn all of their money from Washington, and they say, well, I earned it all at Kaiser, so I don't need to. Well, Idaho doesn't care. If you live here, then all income you earn while you live here from wherever, Idaho wants it. Where it gets more complicated is when they earn it over in Montana or another state that does have an income tax return, because Montana wants claim to that because it was earned there, and Idaho wants claim to it because you lived here. And so you end up filing two returns. Montana will get their money, Idaho will get their money, but they'll give you credit for what Montana kept. So it's just one more form for us to fill out and calculate, and usually you only end up paying on it once, but it might be in 2 or 3 different states by the time you get done. And that happens quite a bit here.
Mm-hmm. Yes, I can imagine that it does. Tori, with regard to trusts, we hear a lot about living trusts and other kinds of trusts and estates also. Are they taxed at the same rates as individuals are taxed at?
No, they're certainly not. They have their own tax brackets and rates, and in some cases methods of calculating the taxable income. There's quite a bit of differences there.
And they may be higher, is that correct?
Yes,
so that's
yes.
definitely something to take into consideration when you're doing estate planning,
Mm-hmm.
is you want to consider the whole thing. Is that correct?
Yes, I agree.
And Rob, what about
There's
you
different
have
types
something
of
to add
trusts
there.
too.
Right.
You know, the most common one we see that a lot of people are looking at is what's called the living trust, where it's in a method to avoid probate. Well, if you put your assets into a living trust, the trust really normally doesn't even file a tax return, because as a grantor of that trust, everything is taxed onto the grantor's tax return. So you're avoiding the tax. You know, there's no consequences over on the trust side. The important thing there is, if you're going to set up that type of trust, is to change title. You know, if you still got your house registered in your name, then you haven't avoided probate. So that's one of the things people consider.
What happens, though, if that trust continues on past the date of death?
Well, normally what happens at the date of death, if say you have a couple, and at the date of death it divides into 2 trusts, the ongoing living trust and what they call the survivor trust or whatever. And normally in the survivor trust, or the trust under the will, the income is payable to the surviving spouse for his or her health, welfare, and maintenance, and usually it's all distributed out to that spouse and therefore taxed on that return. What the trust pays tax on would be any gains on corpus items. You know, if they have stocks that they sell at a gain, or if there's a piece of ground they sell at a gain. And depending on how long they've held those things, the gain may or may not be much, because at date of passing, there becomes a new basis for the asset. But so you can end up with 2 separate trusts, and that's what normally happens in most of these trust documents. In a living trust, is it becomes 2 separate trusts. And the reason for that, besides the probate issue, is the federal and state inheritance tax issue, because they'll normally put $600,000 of value into the trust under the will, and the rest of it goes into the survivor trust, and that's to avoid there's a $600,000 unified gift and inheritance tax exclusion, so they'll use all that up, and then the rest pours over into the surviving spouse, or it may just split into 2 pieces depending on how it's set up.
And if the trust continues on beyond the death of both of the original grantors, then what happens in terms of the rates?
Again, depending on how the trust is written up, usually in those situations, easy answer, is that you know, again, the income is being required to be paid out to either the children of the original trustors or their children. So again, you're going to hit the same issues there. What you may hit is at the time of death is what they call a generation skipping tax, which is something we don't probably have the time or the desire to talk about. But so it depends on the trust document. Most trusts, though, are set up that at the passing of the second spouse, they disappear, and the assets are distributed out to the children or to the grandchildren or however.
Probably the bottom line then is that if you are considering something like that, you need to carefully check with your tax advisors and with your attorney with respect to those
and
matters.
actually, they need to do it when they're drawing up the papers.
Yes.
Is when they need to do it, because quite often those trusts, if it has $100,000 in there and it makes $10,000 of income, if the trust document is worded that the $10,000 stays in there and pays tax at the trust level, that's probably about the highest tax you'll ever pay on it. Versus if the $10,000 can be distributed to whoever the trust is for, they may or may not pay any tax on it. If it's to children, for instance, they may have enough of them that they don't pay any tax. So, but it depends on what the trust document says. So that's the time when they need to check with somebody.
Steve Sheen.
We don't have much time left, but I thought I'd move to a more positive topic. But we're into the 97 tax year already. I thought I'd ask each of you, starting with Rob and working down the line, to give us one piece of advice on how to minimize income tax for the current year.
One would be to look at shifting assets to a lower tax bracket individuals such as your children. You know, one, because like I said earlier, they can have their own brackets depending on age, how that works, and also it's a way to fund on a reduced or potentially somewhat tax-free basis toward their college education. You know, that's what we set up when our children were young, and granted they changed the rules after we set it up, so it didn't work quite as well as it should have, but that would be my idea.
Tori?
I would suggest taking full advantage of any tax-deferred savings options through your workplace, 401k plans, cafeteria plans, particularly cafeteria plans if you're paying child care or insurance premiums. The beauty of something like a 401k or an IRA is you avoid the tax, but it's still your money. Most deductions, you have to give the money to someone else. You may not be able to touch it, but it's still your money.
And we're down to about a minute left. Randy?
The main thing is don't make so much. It's the easiest way, but I don't really espouse that. No, it's a matter of what you do make, try and keep as low bracket as you can, and what you do spend, if it's deductible, make sure you keep track of it. That's record keeping is the thing, I guess.
On that note, I have to bring the program to conclusion, and I want to thank all three of you members of the CPA firms that you represent and our panel and staff for being here. Ladies and gentlemen, I know you found this program to be informative, and we hope it helps you in preparing taxes, and I invite you to be with us again next week at this same time when we will discuss yet another issue. Until then, please have a good week. I am Tony Stewart.
The North Idaho College Public Forum was videotaped live from the studios of Instructional Technology on the campus of North Idaho College for viewing at this more appropriate time. We invite you to join us again next week for another all-new edition of the North Idaho College Public Forum on this public television station.